first off, your takeaway from these Fed minutes.
Well, thank you. I don't think there's anything too surprising in the minutes. The Fed was very dovish, and they laid about their 4 tools for implementing any more monetary policy or any more stimulus in the economy. But our view is that there's really not a great option. I think that's why you saw the dissents, the 3 members dissent, and I think there's just no clear-cut winner. It's maybe the best of a worst-case scenario going forward.
Yeah, let's talk about that. There seems to be some polarization of the members on the Fed board because we have 3 dissents, right, which is the most in many, many years, the most during Ben Bernanke's tenure as Fed chairman. But then you had other members who went unnamed who wanted more, stronger language than just keeping interest rates ultra low for 2 years.
Exactly. I think that's what we were looking at, too, is they're trying to stoke aggregate demand. At this point in time, I think the committee is kind of undecided about what's going to bring that about. I think the dissenters rightly point out that the Fed wants to be data-dependent and not date-dependent, so they're probably uneasy with the mid-2013 language without any kind of qualifications on maybe unemployment or inflation.
Okay, so when they say more aggressive language, more aggressive action, what are you expecting from the Fed in the coming months?
We think the Fed might take a pause here at the September meeting. If there's going to be any action, it'll probably happen in November. We think the Fed would probably like to have a few more data points under their belt, and maybe that look like they're reacting to the weak equity markets in August. And given that the 10-year rate is basically unchanged since the last Fed meeting and equity markets have rallied, I think that gives the Fed some time to decide what they want to do and let them analyze what's going forward. So again, we don't expect anything in September. Most likely, if you would have some action, it would be in November if data worsens. It would be some kind of operation twist, where they'd be selling front treasuries and perhaps buying longer-dated treasuries.
Yeah, that's what they call it. You buy these longer-dated maturities, replacing the short-term ones. Let me ask you also about the September meeting, because that's going to disappoint a lot of people, because when you heard Ben Bernanke at Jackson Hole saying we're going to extend the September policy meeting, they're thinking, well, wow, we might get QE3 then and not at Jackson Hole.
Well, I do think, again, the Fed wants to be more data dependent to see what happens. I think that it's good to extend the meeting to 2 days to get further discussions. You might see some qualifications for the language. They might throw in something around the unemployment rate or inflation rate, like I alluded to earlier. But I think at this point in time that we'd like to see more data to see if the economy is actually weakening. The confidence numbers that came out today were very weak, but again, that all happened in early August when the debt debate was going on and the equity markets had its lows. So again, I think the Fed would like to see what happens before they start acting.
All right. Well, let's also talk about the Fed's outlook on the recovery, because at Jackson Hole, I think the markets took some reprieve that Bernanke says the recovery was intact in his view. But yet the Fed, again, for the 4th time, cutting its gross domestic product forecast for the second half of this year, 4th consecutive revision lower, and they also cut the 2012 growth forecast as well. To some, these are concerns again.
Very much so. I think the markets reflect that, at least in the rates, with a 10-year Treasury at 2.2%. That's got a lot of bad news priced into it. I think rightly so. The Fed has, come down from their, I would hate to say, rosy growth outlook from the beginning part of the year to probably more realistic one that we view where GDP grows from 2 to 2.5% going forward.
Okay, but no double dip, right, Bret? Is that your view? That seems to be the Fed's view right now.
No, but we're not looking for a double dip, but again, GDP in the first quarter going at less than 1%. I'm not sure there's a big difference between positive 0.4 versus minus 0.4 at this point in time. I think it's going to feel quite like a recession with growth around 1%.
All right, Bret, thank you for your time. Bret Barker.